The recent surge in silver prices has captured global attention. Headlines are flashing, charts are moving upward, and many investors are asking the same question. Is this the beginning of a true silver bull market? The short answer is no. A surge in price does not automatically mean a bull market. To understand why, we need to separate price movement from structural change and speculation from long-term economic forces. Markets don't move randomly. They move because of liquidity, debt cycles, inflation expectations, and investor behavior. When silver rises sharply in a short period, it's often reacting to fear, currency weakness, or short-term demand shocks, not a fundamental shift in supply and demand. A bull market is defined by sustained growth over time, driven by expanding demand, limited supply, and strong underlying economic reasons. What we're seeing in silver right now is mostly a reactionary move, not a structural one. One major driver behind silver's surge is inflation anxiety. When people lose confidence in paper money, they look for hard assets. Silver, like gold, benefits from this mindset. But inflation hedges can spike temporarily without entering long-term bull cycles. We've seen this pattern repeatedly throughout history. Another factor is the weakening of fiat currencies. When the dollar softens, commodities priced in dollars tend to rise. This creates the illusion of strength in silver, when in reality it's often just the currency losing value. That's not a bull market, that's relative pricing. Speculation also plays a huge role. Retail traders, social media narratives, and leveraged positions can push prices higher very quickly. But speculative rallies are fragile. They rely on momentum, not fundamentals. When sentiment changes, prices fall just as fast as they rise. A true bull market requires institutional commitment, not just retail enthusiasm. Long-term investors need clarity on industrial demand, mining output, cost structures, and macroeconomic alignment. Right now, those factors are mixed at best. Silver's industrial use is often cited as a bullish argument. Solar panels, electronics, green energy. While demand is growing, supply is also adapting. Technology improves efficiency, and mining adjusts over time. Bull markets occur when demand outpaces supply consistently. That's not clearly happening yet. Another important point is historical behavior. Silver is highly volatile. It tends to spike during crises and then retrace. These spikes feel exciting, but history shows they rarely sustain without broader economic transformation. Compare this to real bull markets in equities or commodities. Those periods are marked by years of capital inflows, productivity growth, and systemic shifts. Silver's current move lacks that depth. We also need to understand the role of interest rates. When real interest rates are positive, non-yielding assets like silver lose appeal. If rates remain elevated or stabilize, silver faces pressure. A bull market needs a favorable monetary environment, not just uncertainty. Risk management matters here. Chasing silver because it's moving is dangerous. Smart investors ask, what's driving this move, and how long can it realistically last? The reality is that silver's surge reflects fear, uncertainty, and short-term positioning, not a durable bull thesis. That doesn't mean silver is useless. It means expectations must be realistic. Silver can be part of a diversified portfolio. It can hedge certain risks, but treating this surge as the start of a massive, unstoppable bull market ignores how markets actually work. The biggest mistake investors make is confusing noise with signal. Price alone is noise. Structure is the signal. Until we see sustained industrial demand growth, constrained supply, supportive monetary policy, and long-term capital commitment, silver remains in a cyclical rally, not a bull market. Markets reward patience, not excitement. The goal isn't to predict headlines, it's to understand systems. And right now, the system tells us one thing clearly. This surge in silver is not a bull market. Understanding this distinction is critical because mislabeling a rally as a bull market often leads to poor decisions. Investors start over-allocating, ignoring risk, and assuming prices will keep rising simply because they already have. History shows this mindset usually ends the same way, with sharp corrections. Another key element people overlook is liquidity. Many silver rallies are fueled by excess liquidity in the financial system. When money is cheap and abundant, it flows into assets that appear undervalued or safe. Silver benefits during these phases, but when liquidity tightens, that flow reverses quickly. A bull market survives tightening conditions. A liquidity-driven surge does not. It's also important to look at silver relative to other assets. In true bull markets, an asset outperforms consistently across cycles. Silver, however, often lags equities, real assets, and even gold over long periods. Its performance is episodic, not compounding. That alone tells us something fundamental about its nature. Psychology plays a massive role here. Humans are pattern-seeking. When we see price spikes, we instinctively extrapolate the trend forward. This is why late-stage rallies attract the most attention. But markets don't reward emotional reactions. They reward understanding. Media narratives amplify this effect. Words like breakout, historic surge, and once-in-a-generation opportunity create urgency. But urgency is rarely aligned with smart investing. The best opportunities usually feel boring, not explosive. Silver also faces a structural challenge. It sits between two worlds. It's neither purely a monetary asset like gold, nor purely an industrial commodity like copper. This dual identity creates conflicting forces. In times of economic slowdown, industrial demand weakens. In times of growth, monetary hedging weakens. That balance limits sustained upside. Long-term wealth is built by aligning with big, slow-moving trends, productivity growth, innovation, demographic shifts, and capital efficiency. Short-term surges, no matter how dramatic, don't substitute for these forces. This is why experienced investors focus less on price and more on cause and effect relationships. What policy decisions are being made? How are debt levels evolving? Where is real yield heading? These factors determine whether a move has longevity. If silver were entering a true bull market, we would see consistent signals: long-term supply constraints, rising real demand across industries, accommodative monetary conditions, and strong institutional positioning. At the moment, those signals are fragmented. That doesn't mean silver will crash tomorrow. Markets can stay elevated longer than people expect, but elevation is not the same as transformation. The disciplined approach is to treat silver's surge as information, not confirmation. It's a signal to analyze, not a green light to chase. Smart investors ask one final question: what has fundamentally changed? If the answer is unclear, then the conclusion is simple: the move is temporary. In investing, survival comes before returns. Protecting capital matters more than catching every rally. Understanding the difference between a surge and a bull market is part of that protection. Because in the end, wealth isn't created by reacting to noise. It's created by understanding cycles. And that's why, despite the excitement, the surge in silver is still not a bull market.